Ben, lovely to see you. Thank you for coming in.
Nice to see you. Thank you for
Now, let's start with a nice, easy question. How did you get into the industry? And if you hadn't ended up doing what you're doing now in financial services, what do you think you might have done?
How did I get into financial services? So I trained actually as a geographer.
Wow.
So I was a MacArthur Foundation scholar in the US. And I got a master's in geography. In fact, I'm still a fellow of the Royal Society. And my first job, I guess, was for a foundation called Ameritech, interviewing tech managers of technology fabrication plants in the Caribbean.
Wow.
So I often think, actually, if I hadn't have come back to the UK and followed the financial services route, I probably would still be pursuing some sort of economic geography type career.
There's going to be people watching this who are going, why did this guy come back? Why did he come back?
On a rainy day in London, sometimes I think the same thing. But
okay.
Hey, no, I've had a fantastic time. I'm glad I chose the route.
So you did come back, clearly. And what sort of got you into financial services, and where was the sort of real starting point for you?
Well, I started life as an analyst developer at an insurance company. I did that for a little while. But then I moved to Coopers and Lybrand as a strategy and marketing consultant, and PricewaterhouseCoopers as it became PwC. I was invited to go and meet with a partner called Crispin Henderson.
Okay.
And Crispin, who you may know, became CEO of Threadneedle ultimately, but then he was doing some very interesting things in financial services, and I was part of a team that did a number of interesting projects, including launching Direct Line's investment proposition, working with Egg Invest, some of the brands that were trying to do new things even back then in the mid-90s in financial services. And I really got a taste for it, Lawrence, back then. I felt that this combination of technology and advice and investments was a very powerful way of getting good investment advice, investment product to the retail investors.
And that sort of appetite for innovation, particularly through technology, is clearly, one of the things that you majored on with sort of DT. I mean, just before we started, you were talking about the latest piece of innovation that DT's just released.
Yeah. Well, I in the mid-90s, I thought this thing called the internet would be quite big.
You were quite far-sighted.
Well, some of my clients at the time, I remember sitting with one who was running the advice channel for a large bank, said, no, look, we think there's going to be a flash in the pan. So I left PwC and I started a company called Sort, which was the first online advice business ever in the UK. We went to the PIA, as it was then. Yes, a long time ago.
Indeed, yeah.
And we said, look, we think that we can automate financial advice, investment advice, and we'd like to get regulated to do that. And that's what we did. It took us a little while. But it was very successful when we launched it in '98. And we were advising over 1,000 people a day at one point before we sold the business to a company called Empower, which is now owned by Morningstar. So yeah, I mean, innovation is in this combination of technology and investment management is something I am absolutely fascinated by.
So what do you think the sort of role that technology can and perhaps should play in the overall investment selection process? Can it ever take over entirely? We may touch on sort of robo-advice in a few minutes, but is the technology side of it always just an enabler for the sort of the human element, do you think?
That's, we think about technology as, and certainly our role in it, as doing two things at DT really. I mean, firstly, we do think there is such a thing as better investment advice, right? We think that understanding the risk that the client is willing and able to bear, being able to translate that on a consistent basis to the investment manager, who in the retail world never gets to meet the customer, right? I mean, you might, if you're lucky, in the discretionary world, but most of the time these funds are too big, so they'll never get to meet the end investor. And being a translation agent, if you like, for the risk that the client is willing and able to bear. There, in the institutional world, we'd call that your investment mandate.
Yes.
So translating the investment mandate from the investor to the investment is absolutely fundamental to what we do. Technology is an important enabler for that, right? You can't do it manually. You simply can't, because the economics of having, 1,000 asset management meetings every year just wouldn't where you could meet the retail public, just wouldn't work. So the internet plays an incredibly powerful way of distributing that capability. But it is absolutely an enabler, right? So it allows you to deliver high quality, institutional quality investment advice as a retail advisor in the way I've just described. But ultimately, the power for financial advisors is to reduce the cost and risk of your business.
Yeah.
In a post-RDR fee-based world, helping, reducing the cost to serve your customers and your clients is fundamental to a profitable business. If you look at the cost, the number of man hours involved in advising a client on their investments, or their pensions, or their wealth, more broadly defined, they're still too high. And technology like Dynamic Planner allows a lot of the grunt work, a lot of the kind of maths to be done in the background, allowing the advisor to spend time with the client, understanding, consulting with them, helping them build a picture of the future, but ultimately then making sure that the work, the downstream work that has to be done, is done really quickly and efficiently and right first time. And that, that's the key role that we play, which is helping advisors ensure suitability. Ensuring suitability since 2011 has been fundamental to the role that advisors play, and advisors must play. The regulator is very focused on making sure that the investment mandate, the risk the client is willing and able to bear, is accurately translated into the investments that are being recommended and then reviewed on an ongoing basis. And again, if you try and deliver an ongoing service that ensures suitability without the use of technology like ours, very, very difficult now, very difficult. It's just too costly to maintain the review of the client portfolio without using technology like Dynamic Planner. So we definitely see it as an enabler, and that's a very, very important role for technology for now.
And this slightly wider question of how do you think of successful investing? So I think I would define successful, and agree, disagree, as being the client getting what they thought they were getting, which I think is what DT is delivering, trying to deliver. So if that's successful, is that an art or a science, or is it a combination of the two?
It's definitely a combination of the two. A lot is known about the way in which stock markets behave, right? Asset allocation, the importance of asset allocation in driving the variation of returns that investors see. A lot has been, this has been established for many decades. So what DT through Dynamic Planner does is make that available to retail advisors without them having to make the kind of investment in that science themselves. So it's definitely science. Indexes, you could argue, will give you access to a well-balanced portfolio that is designed to deliver the risk and return that the client is looking to gain and is able to bear. So you could argue that the science of asset allocation is a key part to it, and that you could gain access to that as an investor through indices, which again are very, it's a very scientific business. Investment managers, of course, many of them make their living and build their businesses on the ability to outperform. And that, I think, is very much art. The insights, the capabilities of individual managers and teams, the ability to understand where risk lies and to be able to manage that risk, but also to seek out performance, that alpha is absolutely the job of the active manager. And so, yeah, we can see that it is both science and art. And there have been some phenomenal failures of the science, right? I mean, long-term capital back in '98 blowing up, algo trading per se. So you'll never find us saying that algos are the sole answer. They're absolutely not. But it's important to have a really consistent basis, the way in which the client is being assessed, the risk the client is willing and able to bear in their investment plan, the risk that the investment represents, and to have a scientific basis for that is consistent. And then it's down to individual asset managers with the different approaches that they want to take to be able to deliver over and above that.
So
net of fees, of course, which is if you talk about what's a fair outcome, a good outcome for a client, is a risk-adjusted return net of fees.
So do you think we're moving towards a phase, because if you look at the entire advice process, the relationship, the investment selection, where technology can replace the sort of the human, the advisor? I mean, we're all beginning to talk a lot about robo-advice, and for some people that's quite frightening because it sounds like they're going to be replaced by a machine, a robot, or some kind of online sort of platform. How far can we take the use of technology, do you think, in the industry as we sort of have grown up with it?
So I think technology is an enabler for financial advisors and to some degree their customers. Look, I mean, if you're a DIY investor, of which maybe 10% of the population here are, so people with the confidence, the capability and the experience, they're already doing it, right? They're already using one of the handful of established and very comprehensive platforms in which tens, if not over the years, hundreds of millions have been invested. So that segment of the population is well catered. Our interest and advisors' interest is in the 90%. Those of us that are not confident enough or capable enough or don't have the time to make our own financial decisions around our wealth and investments such as they are. And no, I think the role, the reason that people don't invest and don't go down the road to a DIY investment platform is they don't have the confidence. You can put all of the fantastic technology that you'd like in front of an investor that is looking for some advice, and you won't be able to attract that investor, not for a cost that delivers a commercially sustainable result. So we see technology as being an enabler for advisors to reduce the cost and risk of providing high quality advice, but also to increase its access. And I think this is key. I think we're beginning to see advisors use things like our app, for example, our iPad app, much more with their customers. They are using My Planning, which is our client-facing technology, much more frequently, asking the client to go online, review their portfolio, undertake a risk questionnaire, which the advisor then pulls together in a plan which is discussed. In the US, there's been a lot of work around advisor alpha, and that is basically getting the customer to take decisions they wouldn't take otherwise. And that's really the nub of it, right? People don't save and invest enough in this country now simply because advisors don't, there aren't enough advisors to be able to encourage them to do so as they might have done 20 or 30 years ago. A lot of the baby boomers who are retiring now were sold to at university or whenever, in their early 20s by the large sales forces that don't exist anymore. There are a fraction of the number of advisors. So actually access to advice for many consumers is the challenge, and we're all aware of the advice gap. For advisors, profitable access to clients is the challenge. So if you talk to any advice firm, they will say, below a certain threshold of wealth, it's very challenging for us profitably to service those clients. And again, I think, Lawrence, the great opportunity that advice firms face today is to use technology to reduce the cost and risk and increase access to their advice, to their high quality advice.
And when the regulator often talks about access, it's talking about clients with much smaller sums of money. And as you quite rightly said, for many advice businesses now, there is a threshold. £100,000 is a most common one for, some people are looking after cases of 50. But we begin to get below sums of £50,000, say down to 10,000, which could be a sum that your auntie, kind of leaves you in a will type stuff, is not regularly being kind of advised on by the advisor community. Is that where you think technology can play a part sort of going forward, those smaller cases?
Absolutely, absolutely. And if you look at the number one objective on the FCA's business plan this year for 2017, so 2016-17,
yeah.
it is access to advice. And they absolutely have that smaller case and a scenario in their sights. And the opportunity for advice firms that want to go there, I mean, some firms don't, but for those that do want to play in the mass affluent and the mass market, the use of technology like ours, where you can get the client to do more of the work, get the client to risk profile themselves, perhaps even gain answers to some of the simpler questions that they can absorb themselves, we believe could significantly reduce the cost and risk of addressing that market. We've had independent studies done which benchmark what does it take in order to fact find, undertake a suitability review for a client, and then make some recommendations without our technology and with our technology. And with our technology, it's literally 1/10 of the time. And in fact, if we look at some of our advice firm clients who are using Dynamic Planner to its in its most fullest form and in its best way, they are able to see a significant increase in the productivity of their businesses simply because they're using technology to help with this access challenge.
Now, if you're talking to somebody outside the industry at the sort of weekends, I'm using an example of somebody you meet in the pub and you're talking about what you do, and they go, oh yeah, but financial advice is expensive, or fund managers, they're all overpaid. I just want something that's sort of value for money. How would you describe value to money to them?
Value for money. I think value for money, Lawrence, that's a great question, by the way. That's a great question. Normally my answer to that is actually to pull out an iPhone. Which you've asked me not to bring into the interview, right? Yeah. So I don't have it, and to show them the first part of a Dynamic Planner risk profiling questionnaire and some of the answers that they, and the usual response to that is, that's fantastic. Can I see an advisor who's got one of those? Because that for me is quite a engaging process, and it's quite a transparent process, and it's one that shows me the advisor is being both of those things with me. And is more likely to encourage me to do business with them. So I think there are two things really. One is that, actually getting the customer to take action in a way that is good for them, that is good value, right? Yep. Leaving your savings in a savings account which is being attrited because of inflation is not good value for anybody. Yep. It's not going to help you with your retirement. It's not going to help you fund a secure retirement, right? Most people need to save more than they've got today. Most people need to invest in order to get the sorts of returns they'll need in order to secure a retirement. So having a relationship with somebody who's going to help you do that objectively is really key. Yeah. And I think then the answer, the kind of technical answer to your question is, for the level of risk that I am willing and able to take, if I can get a return that is appropriate for that net of fees, then that's a good thing. If you combine those two things together, I think that's the way that we think about value. Okay, lovely. Right, last question. Sort of 4 people, I've described them as innovators because I think you're an innovator, that you would love to get around a sort of table for lunch. People maybe are still alive or in history. Who would they be? Yeah, great question. I think from the investment world, I would love to have Harry Markowitz, who I have heard speak in the States a couple of years ago, and I'd love to hear him talk about the impact that his model and modern portfolio theory has had. I think that would be great. I think, again, from the industry, Jack Bogle, I've had the pleasure of speaking to him briefly in New York. I mean, tremendous mind, 80-something years old, couple of trillion, I think, 2.5 trillion in Ben Goss
like
fund.
They're doing quite well.
You know, he very early on said, look, I think index investing is really important, and it is an important part of the mix. It's not the only thing, but it's an important part of the mix, and he's a guy with an opinion. I think on the tech front, you'd have to have Steve Jobs. I don't think anybody has quite been as visionary in terms of the melding of technology, content, that we all use in our daily lives, and then built a fantastic business off the back of it. And fourth, I'd love to meet James Dyson, actually.
Ah, okay.
You know, British entrepreneur, innovator.
Yeah.
Not only had a fantastic idea, which is based around great product, which is something that I am very focused on myself with DT. You know, he's invested and continues to invest huge amounts in the product in a very scientific way, but also his sales and marketing skills are the envy of companies all around the world. So I think that would be a really interesting lunch.
That would be a fantastic lineup. Thank you very much for coming in.
Oh, thank you. Thanks.